We're going to start with the latest developments on Silicon Valley Bank. Federal regulators shutting down the tech-focused lender today and taking control of its deposits as the company failed to raise capital and shore up its balance sheet. SVB's stock was halted before the market opened today after falling another 60+% in the pre-market. That, of course, on top of yesterday's 62% drop. A month ago, this was an $18 billion stock. Now it may be worth nothing. Let's get more on what's next for the bank and the industry. Danny Fortson joins us, West Coast correspondent for the Sunday Times. And Danny, you're going to have a busy weekend following what comes next, the fallout for startups, and of course, what happens to SVB. Tell us what you're looking into at this point.
Well, it's going to be a very big weekend, right? Because as you have seen in the market, companies like First Republic, some of these other regional banks, they've all seen their stocks crash as well, because of course the fear is that this is the sign of something bigger, that there is contagion. So what is happening right now, I think, are going to be round the clock talks all weekend so that on Monday morning they can come out and say, this company has been bought by a white knight and everybody's deposits will be covered on a one-to-one basis. And that is very important so that they can send a clear signal that this is not the sign of something much deeper and much bigger here.
Yeah, I mean, that would be very positive if they could find that, if the FDIC could find a buyer. Give us a little perspective on Silicon Valley Bank, 16th largest bank in the country. The size has quadrupled in the last 5 years. Talk a little bit about the influence out there and the size and the scope here.
Yeah, so it's a unique bank, right? It's a niche bank, but it's a very important niche. So they market themselves as having at least half of all startups as their clients. But what that means is that they are very exposed. And, you know, what we've seen in the startup world and the tech world in the last 5 years, especially with zero interest rates, there's just been floods of money coming in from venture capital, creating all of these new companies. They've all got onto the books of Silicon Valley Bank. And now, of course, everything's gone into reverse. They started to pull their money out. Interest rates have gone up. The bond rates have gone down. And all of a sudden, they found themselves in a real crunch.
Hey, Danny, what do you think is the most dislocated stock action you saw today on the back of SVB? Was it First Republic? Was it Charles Schwab? Or do you think that this has the ability to cascade further and the story grow from here?
I think the hope, obviously, is that it stops here, right? Because it's a unique bank, and also that, you know, it doesn't have many individual customers. These are startups. And so then they're all controlled by basically a handful of venture capital funds, all of whom said all at once, pull your money out before it's too late. And what it really shows is the herd mentality out here. Once a few venture capital firms tell all their portfolio companies, get out, everybody starts doing it. And they have less than 40,000 commercial clients. So it doesn't take much, doesn't take that many big accounts to really start a run.
Jeff?
Hey, Danny, Jeff Mills. Just a quick question about potential bank regulation. I know it might be a little bit early here, but are there any rumblings around what the implications could be relative to additional regulations coming down the pike once all this is handled?
I think it's a little early for that. But again, I think that's why this weekend is going to be so important, because if they can say, look, this was a liquidity crunch, it was a cash crunch, we have figured it out, we put this into receivership, and accounts are going to be covered on a one-to-one basis, then I think that will be kind of a job done. People can breathe a sigh of relief. But that's why this weekend is critical as a message to the market and, of course, to the wider banking sector.
Danny, we appreciate it. Keep us posted on your reporting. We'll follow it all weekend long. Good to talk to you today. Tim, there are a lot of ripple effects to talk about, whether it's in the banking sector. How about the startups? They funded half of American startups, and now some of these uninsured depositors are waiting to find out whether they're going to even get the cash so they can pay their employees.
Look, there was an argument that the VC world was sidelined even before this news, at least, and they were working off of a capital and money that was in the coffers from last year. As you said, They are the banking partners to 50% or more of the firms that listed. And again, we're talking tech and healthcare. You say, what are the collateral effects? We're going to talk a little bit later about biotech. To me, there are different places where I think you have enormous exposure to this. When you look at the overall risk to the market, this is where people are here. We hadn't been weighing tail risk. Everybody knows that this is the second largest banking failure, since the crisis. Everybody knows that this is the largest banking failure since the crisis. Excuse me.
Since Washington Mutual, I think.
Yeah, and that everybody knows where we are in the stock market, which this week went through the 50, the 100, the 200-day, and that you've got dynamics here where people are evaluating dynamics for the market that we've been talking about. So that's the ripple effect. I think going into a weekend doesn't surprise me what stocks did on a Friday, because as we just talked about and Danny talked about, this weekend's got a lot of news.
So, Steve, does it change your mind on anything? Because, one thing we've heard from all the bank analysts is this is idiosyncratic. It had a unique business model tied to startups. It doesn't necessarily reflect the fundamentals of the banking system.
Yeah, I mean, it makes you want to, that's why I asked that question to Danny. It made me want to step in and buy First Republic for a day trade.
You should have bought it when it's down 50%.
I know,
after the open.
my crystal ball was a little foggy. So you don't know how long this is going to last. You don't know how it's going to cascade. You don't know what the stories are going to be on Monday, who's going to get pulled into this, what the next ongoing risk is going to be. But the trader in me wanted to take a flyer and make sure it's only a 6.5-hour flyer. I don't want to stay along these names. Too much exposure to the downside.
Courtney, what about you?
Yeah, I really don't necessarily see this as something that we need to be concerned about of the overall banking system. I think it's really too preemptive for that. They're primarily lending to VC companies, right? And your larger banks are much better diversified than that. I think what's interesting is when you look at the bond market right now, you look at the credit spreads that did not expand extremely today, which is interesting because that means that people are not putting a ton of extra risk in like a corporate bond and a treasury bond, even with an issue in the banking sector right now.
Doesn't seem quite systemic. Is that what you're saying?
That's exactly right.
What about for regional banks, though? Because, yes, the big banks are well capitalized. We know that.
JP Morgan was up on the day.
JP Morgan was up on the day. It went up early.
Yep.
And receive funds from this bank.
Right,
so
they're taking market share, right?
And so did First Republic.
But what about regional banks? Because that's a pain spot, and a lot of them are in this paid, right? They're funding their long-term treasury holdings with these deposits that are leaving.
No doubt, but they have a different funding base, and we just all have said this. I mean, if you think about the people that have been funding SVB, it's a very different. And we talked about this last night with Gerard Cassidy. I mean, you've got Main Street, more or less, I think, and community trust banks. They're going to argue that this is actually their strength, that they're funded in a very different way. You're talking about both funding liabilities and also the pressure that's going to be on net interest margins when, in fact, people can go to treasuries in 6 months. We know what you can earn on that, what the banks are going to have to pay for these deposits. It's certainly going to hit them on some level. The other side of this that could hurt a lot of banks is one of the events that I think brought this cascade out for SVB, which is a mark-to-market on a securities portfolio that if you're levered and you have an outflow and you have to meet liquidity, they're no different than anybody with a margin call. They had to sell at a loss in a world where there's been a lot of pressure. They clearly were over-levered, and this was a risk management issue. Everyone wants to blame this on the Fed, and I think that's kind of absurd. I mean, I don't defend the Fed outright typically, but I will say that although the Fed has moved quickly here, this is not the Fed. This is a bank
they weren't diversified. This was
a bank that was in.
I guess the question is, are these other banks also, are we going to see who? Well,
First Republic came out. First Republic came out and said the average account size is lower than 200,000. The business is lower than 500,000. Any sector is not greater than 9% of their total deposits within their business sector, within their business deposits. So they're already separating themselves from what we're dealing with on the news flow today. And as far as the major banks, Courtney said it. Mike Mayo was on this morning on a competitor. Liquidity up 50% from, because everyone wants to compare this to the financial crisis. Liquidity is 50% better than it was. Capitalization is 50 to 100% better than it was. And to Tim's point, leverage in the bigger banks is nowhere near what it was, and subprime is not even a blip on the screen.
All things to be grateful for. Right. Although one thing did remind me of crisis times, which is when the Treasury put out a statement from Treasury Secretary Janet Yellen today saying, everything's fine.
Nothing to worry about.
Convened a meeting with all the regulators. There's faith in the system and that the regulators can take care of it. Jeff, want to hear from you. Any changes in the outlook to financials, big or small, as a result?
No, not particularly. I mean, I agree with what everybody else is saying, and I don't want to keep leaning into First Republic. In full disclosure, it is a name that unfortunately we do own, but I have a contact at a startup who actually has accounts at Silicon Valley Bank, and one of the things that they said was as soon as they get their money out, that's exactly where they're going. They're going to move that money to First Republic. So I think a lot of these companies with maybe relationships with those banks out in California, it could be ultimately a windfall for them, even though the stocks have gotten hammered. I mean, that's pure speculation, but I think there is a potential for some opportunity in some of these names that might not have direct exposure and could stand to benefit from money moving in their direction.